Okay, so what are the limitations of income statement? I'm just going to explain non-cash items. Some income statement element like depreciation are non-cash expenses of the company and which don't reflect the actual cash flow. For example, the depreciation of $20,000, if we put on the debit side of the profit and loss account, it reduces the profit, but it does not impact the cash directly. Sometimes there may be one-time gain or loss. There may be some extraordinary items, maybe a lawsuit settlement, and can distort the actual operational performance. Because that the revenue is earned means there is a one-time gain of $50,000, for example, may inflate or increase the profit for the period, but does not indicate regular earning. This is also one of the limitation of income statement and does not account for cash flow. It does not show when the cash is received or paid and making it difficult to assess the liquidity position of the company because liquidity means that how much cash is there in the business to pay liabilities like current liabilities or day-to-day operations and revenues. We can say example here is a revenue of 500,000 may be reported, but if most of it is on credit, a company might face cash flow issues. What does it mean? It means if the revenue, as per the revenue recognition principle, that revenue of this current period should be recorded in the current period or current year, irrespective whether the cash is received or not. This revenue will be consist of that uh, credit sale and cash sale both. But if there is the most of the credit sale, the company might face cash flow issues, but it will not be reflecting in the profit and loss account. Period specific income statement reflects the performance over a set period, but it does not give insight into the longer term trend. So, for example, a strong profit in one quarter does not guarantee long term success. Sometime in the first quarter, there will be a profit. In second quarter, the Tesla company is suffering with a little loss. In third quarter, there may be jump and recovery of the loss, maybe little profit. So this is period specific, but it does not reflect the performance for the long period of time. Now, I'm just going to start with the balance sheet, their uses and limitations. The uses is financial position overview. So, with the help of the balance sheet, that outsiders or anyone who will looking at the balance sheet, they will be able to see a lot of things. And because this is a snapshot of the company's assets, liabilities, and equity. Because balance sheet have two sides. On the left hand side, we write all the assets, and asset consists of fixed assets and current assets. On the right side of the balance sheet, there is the liability side. The liability side reflect the equity means owner's money or shareholder capital, and also reflect the outsider's liability, which may be current liabilities or non-current liability, mean long-term liabilities. Okay, so users here is a company has a 1 million in assets, a $600,000 liability. The equity will be $400,000. What does it mean? It means that $400,000 the owner have invested is owner's money, and $600,000 is outsider's money. Both collectively 1 million dollars company have collected, and once the company has collected have bought assets, so which is reflecting that $400,000 equity and $600,000 liabilities mean outsiders money, maybe bank loan or maybe debentures, debt, bonds, everything we use to buy assets of 1 million. So this is the financial position overview. Liquidity assessment is also one of the important factors, and it helps in evaluating the company's liquidity by comparing the current assets to its current liabilities, which is reflecting on the balance sheet. For example, the current assets like cash, receivables are $300,000, while current liabilities are $200,000, showing that companies can cover short-term obligations. It means current assets are more and current liabilities are less. So company, if today want to pay or ready to pay the full amount, like $200,000 as a liability, so still company will have enough cash in the business that will be $100,000. That will be known as working capital. Solvency evaluation. Solvency. It is clear from the name itself. The balance sheet helps in understanding the company's long-term financial stability, how long it will last in this world. You can say solvency evaluation. If the company debt is $500,000 but equity is $200,000, then it may suggest high leverage, posing solvency risk. It shows that long-term debt long-term debt is more as compared to owners' money invested in the business. If today something happened to the company, then company will have only $200,000 and the liability will be much bigger. So there will be a risk for the solvency. So the balance sheet evaluate the solvency for any company. Decision making tools for investors and creditors. So this is also one of the important points that we want to discuss, that it helps investors and creditors assess whether the company is a good investment company or is a risky one or credit risk company have. So this is the right tool for the investors and creditors. A low debt to equity ratio. Now if we talk about the ratios, the ratio is very simple, not complicated. Debt mean, as I have discussed here, debt is $500,000 divided by $200,000. So this is the debt divided by equity is known as debt to equity ratio. It always should be less than 1, but if it is more, then there is a risk of solvency. And ratio might take companies attractive to investors or creditors. If it is more than 1, it means the debt is if it is less than 1, sorry, if the debt is less, a low debt ratio, so low means less than 1, if more than 1 is the risky. Limitation is historical data. The balance sheet is based on the historical data and may not reflect the current market value, which is true. So what is going on in the market, what is the value of the assets, what is the value of the shares, it's not going to reflect because this is historical data. Building purchased for $300,000 10 years ago. Look, so this is also one of the limitation in the balance sheet. 10 years ago may still appear at the same value, though the market value of that building that could be $500,000 even more, which is not going to be reflected on the balance sheet because of the historical data nature, and does not show the profitability. Yes, no doubt the profitability will be shown the profit and loss account, which is also known as income statement, but it is not shown on the balance sheet. It does not show how well the company is performing in terms of profit or loss. For example, a company may have 1 million in assets but might be running at the loss, yeah, which is true, and not relevant for the balance sheet, and cannot predict future performance. Yes, so it provides a static picture and cannot indicate the future trend. A strong balance sheet today does not ensure the future success if the market conditions change. Yeah, which is true. Intangible assets can be misleading. There may be some intangible assets uh, that we cannot see and touch. So, like goodwill may not represent the actual value. Goodwill may be $100,000, might be overvalued if the company's brand loses reputation, right? So this is one of the case. This may be misleading Income statement elements. So now what we have discussed uses and limitation of the balance sheet. Now we are going to discuss some of the elements of income statement element, which is there are four: revenue, cost of goods sold, operating expenses, and net profit. Revenues, that money earned from selling of the goods and services, for example, $500,000 from the product sale. Now we have cost of goods sold, which is already explained before, that this is the direct cost of the producing of the goods. For example, $300,000 for material and labor. Operating expenses, that also comes on the debit side of the income statement, that cost associated with running the business, for example, rent, utilities, salaries, and other expenses. Like $100,000 rent and salaries, so that will be operating expenses. Net profit is the difference between revenue and expenses. So let's say $100,000 is the profit, the difference between these two. Balance sheet elements are three: assets, liability, and equity. Assets, $500,000 in equipment, 200,000 in cash. And if we talk about the liabilities, these are the obligations the company owe to others. Like for example, $400,000 for the long-term liabilities. And equity, if we say that is a residual interest in the assets after liability are deducted, means assets minus liability is equal to equity, which is also known as accounting equation. And $300,000 is shareholders equity. So we have discussed the uses and limitation of income statement and balance sheet, along with some of the elements, important elements of income statement and balance sheet.